I know when we first started, we weren't going to talk about Dave Ramsey, but he was sort of the other side of the coin. And he had hot takes. But one thing that he said that I kind of wanted to bring to you guys was this concept of combining insurance and investing and what the dangers of that are, but also what the values of that are. Because it seems like it could be, those are meant to be two different things, security and growth. Does an IUL kind of combine those two things, and what's the danger of that?
Well, it certainly can. So there's nothing wrong with term insurance. But when you look at the big picture, right, life insurance is purchased initially for the death benefit, first and foremost for the death benefit. Term insurance expires, right? So why would I be buying a temporary product for a permanent problem, right? So I think that's the problem I have with buy term and invest the difference is I would argue or could argue that we always have an insurance problem, right? You're married, you have children.
Mm-hmm.
If you have a 20-year term and it expires and you pass 25 years from now, what kind of position does that leave your family in from an income replacement standpoint, protection standpoint, paying off of debt?
Mm-hmm.
So your term insurance would have done you no good in that case. It's just money that was flushed down the toilet, essentially.
Yeah.
So there's nothing wrong with term insurance for maybe short-term liabilities, but death is a permanent issue. So permanent insurance is very, very important. And Dave Ramsey kind of argues against that point because he's looking at it strictly from the investment side, not from the protection side. The invest the difference part, I always go back to the human element part of it, which we kind of discussed earlier, which is discipline. So if I'm buying term and I'm investing the difference, am I truly investing the difference? Am I that disciplined to take that money and put it into an instrument that is going to grow over time for me to use in my retirement years? And I think he ignores that part of it. So again, there's nothing wrong with saying term insurance is the option, but it doesn't solve the long-term need that someone has from an insurance need perspective. Now, from the investment side of it, we will never sit here and say that cash value life insurance, IUL, whole life, whatever, is the end all be all. That is not your only strategy that you've got to use, but it can be a very good complement, right? When you look at sort of the rules of money, tax-free money is better than tax-deferred money, right? So if I'm able to pull money out of a tax-free vehicle in my retirement years, is that more beneficial for me from a taxation standpoint than an annuity, a 401k, an IRA would be? Of course it is. But it's not the end-all be-all. It is meant to be a complement. So I think there's a little bit of missed, I don't want to say interpretation, but there is some information missing from his message of what permanent life insurance can be. So I think he looks at it from people saying you have to do this as your full financial plan.
Yeah.
And that's not smart.
Like Dave clearly has personal experience with this. Like he must have run across clients that bought policies that weren't properly structured. Mm-hmm. And I think it's a good thing to be aware of that bad design. I had a conversation with an advisor recently. They had bought a policy with a carrier that will not be mentioned by an advisor that will not be named. And they went out, and it was basically a cash grab for the advisor, right? It's all those things we teach against when we're talking to advisors. It was structured with a high death benefit, minimally funded, so it didn't really have an opportunity to grow and do what it's good at, right? And I think part of a financial advisor's job, and this was clearly just an insurance advisor, right? Just a person that was only focused on selling as many IULs as they could to whoever they could.
Yeah.
But part of the financial advisor's job is to, basically structure every one of their tools they're using in the best possible way to make it, to help it win, help it do what it's good at, right? So I think Dave saying, IUL is bad. Like if it's improperly structured, absolutely. It absolutely is it will not accomplish what these folks online are talking about.
Yeah.
But if we use it as a companion to all these other tools we have in our toolbox, as a volatility buffer when our other accounts that are in the market are down and we can pull from a principal protected tax-free source, that's where it can really win. And I think it just comes down to doing a full financial plan.